Good morning. This is Igor Zuckerman. I'm a president and chief investment officer of Passpon Advisors, and today I would like to talk about ETF market, its developments, its evolution, its current state, and where it's likely to be going next. Uh, Today's talk is meant more as an overview. Um, Although I will probably go into some details. Some of the things that I would like to cover is where the market, the ETF market is today in terms of issuance, what's been working for the issuers, what's been working for investors, what hasn't been working, um, some of the areas of growth currently and potentially into the future. I would like to touch on ETF costs, ETF usage by robo-advisors as well as human advisors, and towards the end, I would like to speak about how our firm approaches ETFs and how it uses ETFs in clients' portfolios as well. So as you can see, it's a pretty ambitious plan to cover quite a few details. I hope you will stay with me for the next 30-35 minutes as I go through this, and I would like to leave maybe 10 minutes or so for questions towards the end. So let's jump straight in. ETF market. It's pretty amazing to have almost 2,000 listed ETFs in US today. It's just, I think, a few dozen short of that number. It has come quite a way from the beginnings, and especially in the last couple of years, the number of ETFs has jumped tremendously. The combined assets under management for ETFs have recently surpassed that of hedge funds, which is an accomplishment in itself and speaks volumes about the popularity of ETFs. There are 78 ETF issuers today. I don't have the actual numbers for how many new ones have entered in the last year or two, but it's easy to say that this number was less than half of that just 2 years ago. It's also interesting to note that the big three ETF issuers control over 80% of the total assets under management. That is, of course, BlackRock, Vanguard, and State Street. Those are the big three of the industry. 2016 was the largest year ever in terms of new issues. 247 new ETFs hit the market in 2016. It was also the largest in terms of closures, 127. We'll talk a little bit about that, about the causes of ETF closures and what does it mean for the market. And of course, the total inflows, nearly 26% increase in total inflows for 2016, and the current market, well, actually, at the end of the year, the market was at $2.54 trillion. I believe it's almost 2.75, 2.75 trillion at current state. So passive investing, I call it ETF 1.0. This is essentially what the idea behind the ETF was: create a passive index and create a product that will follow that index. The first ETF, Spider ETF, I believe was issued in 1993, was just following S&P 500 index. It's still the largest index. I'm sorry, it's still the largest ETF available in US today. Basically, the idea was to replace the mutual fund index funds that Vanguard started before that, because of its tax efficiency and because of its tradability. And so many indices since then have been turned into ETFs. Obviously, not all of them. There's over 10,000 different passive indices, and obviously a lot of them may not necessarily make sense as an ETF, or maybe they just uh, nobody got around to them yet. But in any case, this is the passive investing, and this is the idea behind ETF. Um, Many popular allocations today have multiple issuers, as also known as Me Too products. So some asset classes are large enough where the same essentially index can be represented by multiple big ETF issuers that can only differentiate themselves by, let's say, um, the costs, which is the expense ratio. Um, but by and large, obviously, the Me Too products are not a great innovation or not a great idea for some of the smaller indices where basically the first mover advantage is key. Um, so basically, there are very few new ETFs on those indices that are available today, and the assets under management for those ETFs fluctuates, obviously, with market trends. So whenever, let's say, there is a outflows of bonds, same thing happens to the bond ETFs. Now let's move forward. So what is going on with the market demand? Why is there such a huge inflow? Well, there are a number of factors, but a couple that are different in the last few years than what may have been driving ETFs, let's say, in the previous decade. Millennials, the new investing generation, is looking to be able to trade easily and have full transparency into what they're holding. ETFs is the perfect vehicle for that, much more so than, let's say, mutual funds, let alone hedge funds, as well as some other vehicles, such as closed-end funds, etc. ETF proliferation is also allowing some of the smaller and newer providers to bring their products quicker and cheaper to the market. It used to be the case that the actual legal process to bring an ETF to the market was expensive and long. Now there are other ways of doing that. There are several companies whose entire business model is to help other companies to bring ETFs to the markets quicker, which makes it cheaper and faster. And of course, a lot of companies have taken advantage of that. And then, of course, the fintech and robo-advisors have taken the ETF availability and tradability to the next level in order to provide automated portfolios and other tools for the investors that only increase the visibility and popularity of ETFs. Which brings us to the growth opportunities. This is ETF 2.0, and I would like to go through some of these in a little more detail. These 5 bullet points are essentially where the growth opportunities are. This is where the new ETFs come in, and those who have come on board usually pick up some assets under management. So, how do you improve an ETF? Essentially, once you have, S&P 500 ETF or Gold ETF, GLD, there is other than these so-called Me Too products that I already mentioned. How do you make it attractive to investor? Um, what can you do to that makes sense, that would make it attractive to an investor? Well, there are a couple of different ways. One is a new index construction, whether it's different inclusion mechanism or a different weighting mechanism, which is probably closer to what smart beta is, and we'll talk about that in a few minutes. Or you expand the geography. So let's say a domestic fund, and then you create a global fund or emerging markets fund, for example. Another way is to use exclusion. So what exactly does that mean? An example, and by the way, whenever you see from now on a, a blue font, that's a ticker of an existing fund, of an existing ETF. VEU is a ticker for an ETF that includes all world except US, and this is what the exclusion is. So DTN is another one. Right after the financial crisis, it was very popular to exclude financials from some of the indices. Another one is XMX. This is actually a very new fund that was just issued shortly after President Trump's victory, and this one is a global equity allocation ex-Mexico. So Mexico is excluded. To be honest with you, I am not sure there's a place for a fund like that, but the issuer clearly thought that was a possibility. So this is the exclusion. This is taking an existing index and modifying it for the demand of, or at least the perceived demand of potential investors. Another way is hedging. So you can do things like currency hedging, which has been very popular in the last couple of years, as the Fed is basically the only central bank raising the interest rates. Investing in foreign equities carries a significant currency risk, and these are some of the ETFs that have garnered a lot of assets using currency hedge. There is also obviously a volatility hedge, and recently also funds focusing on the interest rates hedge, clearly as interest rates are going up. And yet another way of potentially creating a new ETF from an existing one is to create a finer and finer slice of the market. These are some of the subsectors, or rather sub-industries of the existing ETFs that have been carved out because there was demand. And by the way, the bottom two, restaurants and liquor ETFs, are very, very new, less than 6 months old. And again, these are just examples. There's more of those, but this is just to give you an idea of how some of the new ETFs get created. And then, of course, there are truly new products. Well, where do they come from? There's basically three cases for that. One is a new asset class, and you can see some of those. Those are not necessarily really new asset classes. They're just new to be tracked by an ETF. So alternatives and hedge funds, obviously managed futures. This is a very popular fund. It was released a few years ago. Closed-end funds. CEFS is a brand new fund that started trading, I believe, last week. An interesting story about that one. It's issued by a hedge fund called Saba Capital, run by Boaz Weinstein, who used to run credit trading at Deutsche Bank before the financial crisis, and he started the Saba Capital, and this is one of the businesses that they decided to branch out to, managing an ETF of closed-end funds that are focused in credit. Some other ones you see here, credit spreads, CDS. Unfortunately, those two have closed. They looked promising when they were issued in 2014, but didn't quite survive. And of course, digital currency. Coin was supposed to be the new ETF representing the Bitcoin. For those of you who followed, probably know that just a couple of weeks ago, the SEC, after 2-year review, finally rejected the ETF in its current form. That doesn't mean that we'll never see a Bitcoin ETF, but not that one anyway. So these are just again some of the examples of the asset classes that may be represented in ETF products going forward. Also, there are new ETF products based on completely different ways of building indices. So you can see some examples here as well. Things like corporate actions, whether it's IPOs or spin-offs or insider buying and selling. Short squeeze, that's a very new fund as well. Religious values, in this case Catholic, also pretty new fund. And then copycat and activist investor based on filings made by hedge funds and activist investors. Another area is trying to differentiate the companies by who runs them, the customer satisfaction and brand value. And the last one in this category is social media insights, BUZ. I believe that ETF that was also issued last year has had some recognition from the industry in terms of its innovation, just essentially gathering social media following and building an index based on that, a dynamic index, I might add. And then, of course, there's asset allocation strategies. Those either fund of funds or multi-asset income funds that have been very popular in the last couple of years in the low-rate environment. Those, of course, are also new ETF products, not necessarily built on indices. In fact, a lot of them, some of them are rule-based, a lot of them are actively managed, and we'll talk about actively managed just in a few minutes. This is also a good time to talk about ETF closures. Obviously, 127 funds closed just last year. If you think about it, this is essentially one in every 2 business days. An ETF was closed last year. It sounds like a lot, and there are a number of different reasons for it. First of all, ETF is a business. Most investors probably don't think of it this way, but for the issuer, it's definitely what's driving them to go into the business or to close the ETF if it's not profitable. So at the end of the day, that expense ratio that you're looking at, this is how an ETF issuer makes money, and if that expense ratio multiplied by the assets under management isn't enough to cover expenses, that will usually mean that the ETF is unprofitable and will probably not survive unless this is a temporary situation. The issuer costs vary based on many factors, but a lot of it is economy of scale. So I mentioned that there are some companies whose business is essentially ETF in the box. They help smaller companies bring new ETF products to the market, but there are obviously costs associated with it. There are some upfront costs, and then there are costs of running this business, um, operational, legal, compliance, rebalancing, index costs, and so forth. I'm actually speaking from experience because our company has been involved in potentially bringing some of those new ETFs to the market. It didn't quite materialize for us, but we've gone through this process and we know intimately what's involved in that. So, so the problem for the smaller company is that their break-even point is much higher than that for a big company where their legal as well as marketing and distribution costs can be very well mitigated by the fact that they're larger and they've already done this process with other companies, with other ETFs, and they have relationships with other companies who will help them with marketing and distribution. And this is why some of the larger funds can afford to have such small expense ratios, while some of the smaller funds often have pretty high expense ratio, and they still can survive. And of course, liquidity is also an issue. Even if you have enough assets under management, which for small companies, the break-even is usually around 45 million under management. If it's not liquid enough, if it trades less than, let's say, 30,000 shares a day, it may still spell doom for an ETF. In addition to that obvious economics of the ETF market, there are also plan closures. Many investors may not realize, but there's a simple explanation for some of the ETFs to be closed. It's in their prospectus. They're meant to close at a certain time. The example I've given here are bullet shares. These are ETFs covering corporate bonds that mature at a specific end of the year, which in this case was 2016, so they closed and returned money to investors. And then, of course, the other one is an issue with ETNs. ETNs, for those who are not familiar, are similar to ETFs, but they're not funds. They're exchange-traded notes. And the main difference here is that rather than holding the underlying positions, they actually offer a note to the investor. Essentially, this is a fixed income instrument issued by the issuer to the investor that promises to track closely whatever underlying index they advertise to follow. An issue with that, aside from actually having a credit risk to the investor, is that it falls under a different category. So for many financial regulations, including international regulations such as Basel, this is considered to be debt, and it impacts banks' debt ratio and potentially other covenants. So after 2008, a number of banks tried to reduce these types of issues, especially those that have grown large. So DWTI and UWTI, which were leveraged ETNs based on oil, they closed in November of last year with these amounts under management, which would, the second one would make it the largest closure ever. So even though clearly it was profitable and had quite a bit under management. They had to close them for the reason, for the regulatory reason, essentially. And this was Credit Suisse, and they've done this before. So this is something to be aware of for an investor. And another issue with ETNs potentially also is that the creation of new shares is different than it is with ETFs. The issuer itself has to basically do it rather than authorized market participants, which means sometimes the creation of new shares can stop when it grows too large, which happened to GAZ, G-A-Z. It actually happened in 2008, but it was finally essentially put out of its misery last year and replaced with GAZ-B in 2008 when commodities started falling. New shares stopped being created for gas, and they never resumed. So rather than fixing it, the issuer decided to close it and open a new one. So we're really behind on time, so I'm going to try to speed it up. Active ETFs. Well, why active ETFs? Well, first of all, the reason you would want active management in ETFs is the same as active management anywhere else. It's for being able to manage situations where there's higher differentiation of products and higher volatility. These are just some of the examples where you can see those active ETFs. It doesn't guarantee that it works or that it outperforms the passive indices. And in fact, the last one that I've included here, the dividends, doesn't seem to be driving a lot of demand. DV, which was the largest of the dividend active ETFs, they just recently announced that they're closing that fund. Now, there's 172 active ETFs, and they manage less than 1% of total ETFs assets under management. Costs is one of the issue, as the largest passive ETFs essentially converging to zero. The cost for the active ETFs is actually pretty high. There is also a regulation that requires daily position disclosures for the actively managed ETFs, which poses some issues for many issuers. They would rather not disclose the positions for fear that they would be duplicated. So it's a case of transparency versus tradability. One of the possible solutions was non-transparent ETMF, which was approved a couple of years ago. It's an exchange-traded managed fund. It was developed by Ethan Vance and would have a 30-day reporting and would trade based on discount premium to NAV rather than the actual price. An interesting idea. Unfortunately, my understanding is that this would require a whole different type of trading systems that are simply not available yet. It's not clear what the future of this product is. This was just one of the possible solutions to get around active ETF issues. So that remains to be seen. Moving on to smart beta. Smart beta is a term from the modern portfolio theory. As you can see from the graph, this is what beta really means. And of course, the whole idea was that initially most of the indices and the ETFs based on them were based on market cap. So anything that uses a different structure was termed smart beta. These are just some of the examples. Equal weight RSP was the S&P 500 equal weight index that has outperformed SPY over the past 15 years quite significantly, which is it's considered to be essentially the first smart beta in ETF, although it wasn't called that back then. And these are just some of the examples of the smart beta that's out there. Of course, when you start combining those factors, you have a multi-factor, which is essentially a strategy in an ETF wrapper. These are some of the examples that I've given below. One of the more popular ones is combining volatility, low volatility and high dividend. And then there are others that combine 4 and even 5 factors together that have also been gathering a lot of assets lately. A lot of large companies have entered this space, including JP Morgan, Goldman Sachs, John Hancock, and Deutsche Bank. And the reason why is this happening now, this is what I again call ETF 2.0. ETF can now hold a strategy like that rather than having let's say separately managed accounts for their asset management business. It is now cheaper for these companies to actually put these strategies in an ETF wrapper and make them available not only for their own clients but for the masses. So this is the natural evolution of the market. And then the other area of growth is investing themes. So an investing theme is essentially a trend. It could be due to economic or demographic, technological factors, which are the most popular ones, could also be geopolitical or regulatory. This has also been a staple in institutional portfolios for many years and unavailable to retail investors, and is now becoming more and more commonplace. So these are some of the theme examples. Just look at the technology that has been out there: Internet of Things, cybersecurity, fintech, mobile computing, genomics, immunotherapy, all these ideas, all these technological advances have now a dedicated ETF to them. Geopolitical and economic, again, obviously the emerging markets was a big theme. But there's also demand for water. There are several ETFs now. The last one that's mentioned here, WTRX, is a new one that's also actively managed. Infrastructure improvements has been a theme for a while and is now a big theme again in the agenda of the new administration. So again, the last one listed here, PAVE, is a brand new ETF focused on U.S. infrastructure improvements. Change in clean energy usage and storage is also another big economic factor driving those ETFs listed. Here are a few more examples. Socially responsible investing is becoming more and more popular, SRI or ESG, which stands for environmental, social, and governance. The one that I would like to mention here is an ETF with a ticker SHE, S-H-E, dedicated to women's leadership. Other social trends, as you can see, again, fitness, organic food, and also demographic. Finally, there are ETFs for millennials and for baby boomers and their impact on the economy. So, what to expect next from the ETF market? it will most definitely continue to grow assets under management. Perhaps 4 will probably drive expense ratios to 0 for some of the largest funds. Um, Innovation will continue to drive new products. I expect eventually to see legislation that will allow active ETFs to start replacing mutual funds completely. Smart beta will continue to grow, but I expect multi-factor to become very, very popular if it hasn't yet. Thematic investing. This is a great area that we are primarily interested in, and we think that not only it will continue to grow, but unfortunately within the ETF format, it will continue to be hit and miss depending on the demand from the investors. And of course, there's fintech. Fintech is trying to disrupt ETF industry and will probably continue to do so. So why fintech? Well, this little table basically summarizes it. Essentially, fintech can be cheaper, can get it to market faster, and can allow the types of the types of flexibility that ETFs, as flexible as they are, can just can't do. This is one of the fintechs that's leading in this space. It's called Motif Investing. This is basically their little resume right here. Essentially, they will create an ETF-like portfolio for you, or you can create it for yourself, or your advisor can create it for you on their advisor platform. And it trades as a single entity. These are some of the use cases for motifs, and it goes beyond just using themes. You can create a fund of ETFs. You can have a subset of an existing ETF. You can essentially create any kind of custom portfolio for yourself or have somebody else create it for you. A couple of words about me. Again, I'm Igor Zuckerman, and I'm a President and Chief Investment Officer of Passport Advisors. This is briefly my experience over 20 years in the industry. And this is our firm's approach to themes. So we have identified some of the themes that we believe will drive the next decade. These are just some of the past themes that have been recently turned into ETFs. You can see them here, and we use Motif extensively for over 300 different themes that we use for our clients' accounts. What we offer is automated portfolio allocation process, automated or high-touch theme allocation. Again, this is a hybrid digital and human advisory service. We also do portfolio maintenance and rebalancing for all of those ETFs and those portfolios. What's coming soon, really soon, is also we will start donating some of the fees to the charity of choice for our investors. We are rolling out free 3-month trial, and we will have lower fees for digital-only account and a dedicated mobile app is also coming. This is a glimpse into what our portfolio allocation process looks like. That is all ETFs. Again, the core, and then the core portfolio, and then the tactical allocation to themes. These are some of the examples of the motifs that we offer. And just finally, what's in the name? In case you're wondering, Pass Pawn Advisors is from a chess term where pass pawn is the weakest piece on the board, but has a chance to go across the board and become a queen. So that's the game changer. Join us and change the game. I think we're just about out of time. I think I've covered as much as as much as I can get. So I am open to answer questions. The only question I see so far is it possible to get a copy of your slides? I believe BrightTalk provides copies of that slide of the slides that will be available once the presentation is over. I also wanted to mention on the thematic investing is that there is an article that I'm working on that will be coming out probably by next week on Seeking Alpha. That will be a primer on thematic investing. We'll cover thematic investing in a lot more detail. I've also done a presentation on thematic investing on BrightTalk, so if you search BrightTalk, you'll find that presentation from, I believe it was this summer of last year, for those of you who are interested. Are there any other questions? All right. In that case, I thank you all for joining us today. I hope you enjoyed the talk. Please feel free to leave feedback for us for the future, and make sure you check us out on Facebook and on Twitter and on our website for our offerings and for future presentations, talks, and articles. Thank you.